Luca Pacioli was a wandering Franciscan monk and mathematician. He was a contemporary of Columbus and a friend and collaborator of Leonardo da Vinci's. His seminal work, Summa de Arithmetica, was published in 1494. It contained a section, Details of Accounting and Recording, that described the system used in Venice. This was 4 decades after Gutenberg's invention of movable type. Printing centers all over Europe allowed Pacioli's Summa to be translated, printed, and the ideas soon spread across the continent. In a way, the printing press was the equivalent in his time of the internet today, kind of at the bleeding edge of technology.
In any profession that involves some technical competence, be it economics, plumbing, or medicine, jargons that facilitate communication within the profession make its communication with outsiders more difficult. A little more cynically, all technical professions have an incentive to make themselves look more complicated than they really are so that they can justify the high fees their members charge for their services.
Well, Luca Pacioli did not invent double entry accounting. He did popularize it in medieval Europe. It had been described at least 600 years earlier in Persia by Muhammad al-Khwarizmi, though the Eurocentric textbooks I studied about 40 years ago claimed Pacioli as the originator of our modern accounting system. Regardless of who invented double entry accounting, it is beautifully and elegantly simple. While the accounting profession would have everyone else believe that accounting is excruciatingly complex, the underlying algorithm can be learned quite simply in a few days. However, just like any skill, it takes much longer to absorb effectively. While the underlying theory is fairly simple, skilled technicians must learn to apply it almost without thinking. That takes experience and forms a foundation for later specialization in auditing, taxation, or accounting systems design.
Your instructors for this course include ChatGPT, a new artificial intelligence tool. We also used a little actual intelligence provided by Wikipedia and Investopedia, and internet search tools provided by both Microsoft and Google. The materials were assembled using Microsoft PowerPoint by Rob Farrow, a retired CPA and the executive director of SBA Canada.
In part 1, we'll answer the following questions. Who is interested in accounting, how they use accounting information, and why it's important to them. We'll also discuss the what of accounting. That means understanding what transactions are and what they represent. Finally, we'll touch on the when and where of accounting, though we describe that in much more detail in another lesson, The Evolution of Accounting, which also talks about the origins and a little bit about the technology underlying accounting.
So, who uses accounting information? Owners and owner-managers of businesses need to know if they are making money. They need to know who owes them money, how much tax they have to pay, and which suppliers they owe money to. Tax authorities rely on businesses to pay their taxes to pay for government services. Modern states take on responsibilities for defense, policing, road building and maintenance, as well as the regulation of private sector businesses and non-profit organizations. Lenders, suppliers, and investors often require financial information. They need to know how reliable prospective borrowers, customers, or investee companies are. So, what is accounting information? Accounting information involves first, the recording of financial exchanges or transactions, and second, the summarizing of this transaction data into financial statements that are understandable to users. When did accounting originate? The short answer is that accounting originated a long time ago. Most cultures had some form of record keeping to keep track of tax payments. So the when and the where depends on who you ask. In Europe, it dates back to at least the 13th century. We also have records of accounting systems earlier than that in Korea, India, and the Middle East.
So what is accounting all about? Business entities record transactions. These transactions are the what of accounting. In fact, the most common transactions involve both the purchase and the sale of goods. When a baker sells his or her baked goods in a market, they're participating in a sales transaction. When the owner of a tavern buys the same bread from the baker to sell in their tavern, they're participating in a purchase transaction. But it's the same transaction. However, from the perspective of the baker, it's a sales transaction. The owner of the tavern is purchasing bread to sell in the tavern. For them, it's a purchase transaction. Each entity involved in the transaction records it from their own perspective. The baker trades baked goods for money. The owner of the tavern trades money for baked goods. Trading is the essence of all our human economic systems, and that hasn't changed since our ancestors met in medieval markets or traveled great distance by camel or canoe to trade local foodstuffs for manufactured goods.
Once again, we look up the term, in this case transaction, in a dictionary. A financial transaction is an agreement, or communication, between a buyer and seller to exchange goods, services, or assets for payment. Any transaction involves a change in the status of the finances of two or more businesses or individuals. A financial transaction involves one or more financial assets, most commonly money or another valuable item such as gold or silver. There are many types of financial transactions. The most common type, purchases, occur when a good, service or other commodity is sold to a consumer in exchange for money. Purchases are either made with cash payments, including physical currency, debit cards, or checks, or in exchange for a promise to repay later.
So, what is meant by the entity concept in accounting? According to our research on ChatGPT, the entity concept, also known as the entity assumption or entity principle, is a fundamental concept in accounting. It refers to the idea that a business or organization is treated as a separate and distinct economic entity from its owners or other entities. According to the entity concept, the financial transactions and activities of a business should be recorded and reported separately from the personal transactions of its owners or any other businesses they may be involved in. This principle is based on the belief that the business entity has its own rights, obligations, and financial standing that should be clearly distinguished from the personal affairs of its owners. The entity concept helps ensure that the financial statements of a business provide relevant and reliable information about its performance and financial position. By treating the business as a separate entity, it becomes possible to assess its profitability, liquidity, and solvency independently of its owners. In practice, the entity concept requires businesses to maintain separate accounting records for their business transactions, separate bank accounts, and separate financial statements. Personal expenses or transactions of the owners should not be mixed with those of the business. This separation allows for a clearer understanding of the business's financial health and facilitates accountability and decision-making for both internal and external users of financial information.
When working with a concept that has legal significance, it's often helpful to look it up in a standard dictionary. In this slide, we looked up the word entity in an online dictionary. Often in law, when a concept is not defined in legislation, we must look to the ordinary meaning of words to understand its meaning. Lawyers sometimes call this the plain meaning rule.
In addition to the three basic types of business entity, that is, proprietorships, partnerships and corporations, there are also two other forms of business entity. They are limited partnerships and joint ventures. These are less common and we will study these later, when we look at income tax and business law. For the purposes of this course, let's not confuse things. Introductory accounting courses generally look at business entities even though there are other types of entity that require accounting information. Can you think of what some of these other entities might be?
Modern accounting originated more than 1,000 years ago, probably in Persia. It involves the recording and compiling of transactions, which are the fundamental components of human trading activity. The participants in each transaction or trade are separate entities. They each record the two parts of the transaction, from their own perspective. This financial information is commonly used by managers of the entity, by tax authorities, investors, lenders, and suppliers.
Now it's time to press pause, stretch your legs, and grab a coffee or make a cup of tea. See you later.
In part 2, we'll look at the how of accounting. Fundamentally, accounting is a practical necessity for people engaged in a business activity in a country like Canada. We do this for many reasons. We may need to pay employees who work for us. We may need to bill customers for services performed. We need to calculate our income and file our tax returns. And we need to know which customers have paid us and how much. If anything, they still owe us. The term double entry accounting refers to the fact that every transaction has at least two parts. One is the debit part, the other the credit part. But what the heck is a debit?
The word credit is now widely used in the English language. It has its origins in the practice of double-entry bookkeeping. While credit has positive connotations in the language, it has no such positive connotations in accounting. In accounting, credits and debits are merely counters or signs, like plus and minus. Unlike plus and minus, debits and credits can either increase or decrease depending on the context.
When it comes to recording transactions, double-entry bookkeeping has two fundamental rules. Rule number 1, accounting is the compilation of transactions, each of which involves at least two parts called accounts. By convention, we call these two parts the debit part and the credit part. Rule number 2, in any transaction, the sum of debits must equal the sum of credits. If you recall from our lesson on the evolution of accounting, double-entry accounting was first described in the 8th century by a Persian mathematician named Muhammad al-Khwarizmi. He's often referred to as the father of modern algebra. Not surprisingly, he sprinkled a little bit of that algebra into the fundamental balance sheet equation. According to the theory, the sum of an entity's assets must equal the total of its liabilities and the owner's equity in the business. In other words, everything a business entity has under its control must either be owned outright by the business or have a claim against it. The claim is called a liability. For example, if a business owner buys a car with a combination of cash and the assumption of a car loan, the business reports the entire cost of the car along with their equity in it and the remaining debt to the lender. The balance sheet equation is reproduced graphically here. The cost of all of the assets under an entity's control must equal the sum of owner's equity derived from investment by the owners and or the undistributed earnings of the business over time, plus any debts or other amounts owed to third parties outside the business. There's another important concept called the time period concept. Accountants accumulate income for a time period, usually a year, and then close it to owner's equity at the end of the year. The balance sheet only balances because it already includes the income or profit for the year in owner's equity. The income statement, by contrast, only contains the detailed trading activities for the particular year. It shows how much you sold and what it cost you to sell those goods and services. At the end of the year, that income is closed to owner's equity. Interestingly, well, it interested me anyway, in the 19th century, auditors only presented an audited balance sheet. Modern auditing began in 1844 when the British Parliament passed the Joint Stock Companies Act. For the first time, the act required that directors report to shareholders via an audited financial statement, the balance sheet. The U.S. Securities Acts of 1933 and 1934 created the Securities Exchange Commission, which regulated the major stock exchanges in the U.S. This legislation greatly influenced auditing around the world. Companies wishing to trade shares on the American stock exchanges were required to issue audited income statements as well as audited balance sheets. As we said earlier, the balance sheet equation tells us that the sum of all assets controlled by the entity equals the net capital or money contributed by the shareholders or owners of the business, plus any undistributed income earned since the inception of the business. As we implied earlier, people new to accounting usually struggle with the concept of debits and credits. Their biggest problem probably results from the fact that the words debit and credit have built-in connotations in our language. In accounting speak, those connotations only get in the way. Debits and credits are merely counters. In this slide, we've put together a cheat sheet that shows the effect of debits and credits on the balance of different types of account. In the next slide, we'll show how that works in conjunction with the balance sheet equation. If we look at the asset side of the balance sheet, we see that the two assets are both increased by debits. On the liabilities and equities side, everything except expenses is increased with a credit. However, profit is the difference between revenue or sales and expenses. If the business made a profit, sales exceed expenses, and we would close the net credit to equity. In other words, profit taken together is also increased by credits. If all of this is a little bit too much to grasp at the moment, we've located a short video explaining debits and credits by a professional accountant out of Ireland.
In this presentation, we introduced several key accounting concepts. You must master all of these to become a skilled accounting technician.
But don't beat yourself up if you're having a little trouble getting it all to line up right away. As with anything else, you'll get better at it with lots of practice.